Welcome back to the deep dive. Today we are tackling a subject that usually sits right at the bottom of the to-do list. I'm talking about that zone between clean the gutters and organize the junk drawer.
It is the ultimate procrastination topic.
It is. We are talking about life insurance. But before you instinctively reach for that skip button, just hold on. Because looking through the research we have today, specifically the insights from Muneris Financial Services and their specialist, Mansour, this isn't actually about death.
No, not really. It's about money, math, and strategy.
Exactly.
And that's the right way to frame it. The goal for this deep dive is to, strip away the sales pitch. We aren't here to sell a policy. We're looking at the purest form of financial protection available to Canadian families.
Term life insurance.
Just term life.
And it's interesting because the notes from Muneris frame this as a toolkit. We aren't just defining terms. We're going to break down the exact formulas to calculate your coverage, why renting your insurance is usually smarter than buying it, and a strategy called laddering that I have to say I hadn't heard of before.
Oh, laddering is a game changer for efficiency. We'll definitely get there.
Yeah.
But you're right. The industry is just filled with jargon, whole life, universal life, term to 100.
It feels designed to be confusing.
It is. Our mission today is to give you the decoder ring so you can look at a policy and know exactly what you're looking at.
Okay, so let's start with that headline concept. The sources draw a really hard line between term insurance and everything else. I think the best way in is that analogy of renting versus buying.
Yes.
Because usually in finance, we're told renting is just throwing money away.
In real estate, often, yeah. But in insurance, no. Think of whole life insurance, which we aren't focusing on today, as buying a house. It's permanent.
Right.
You pay a mortgage, you build equity, and you own it forever. It's an asset, but it's incredibly expensive.
Which makes term life the apartment rental.
Exactly. With term, you are signing a lease. You're saying, I need coverage for my life for the next 10, 20, or 30 years. You pay your monthly rent. If you pass away during that lease, the insurance company pays out the death benefit. In Canada, that's a tax-free lump sum to your family.
But and this is the psychological hurdle the text mentions, is that if you survive the lease,
You get nothing back.
you don't get your rent money back.
You move out and you have no equity. And that drives people crazy. They feel like they lost all that money because they didn't, die.
Which, when you say it out loud, is a very strange complaint. Darn, I'm still alive.
It's totally irrational, but it's human nature. We just hate sunk costs.
Yeah.
But the Muneris notes use another analogy I think nails this perfectly.
The Netflix subscription. I liked this one.
You pay your $20 a month to Netflix for access.
Yeah.
If you watch 100 movies, great. If you watch 0, you still have the access.
You don't call them after 10 years and demand a refund.
No. You were paying for the optionality. For the risk transfer, you paid a small fee so that if a catastrophe happened, a massive check would show up.
And because there's no savings account attached to it, no cash value.
It is dirt cheap compared to permanent insurance.
And we're talking a significant difference, right? Not just a few bucks a month.
Oh, huge. For a healthy 35-year-old, a term policy might be 10 to 15 times cheaper than a whole life policy for the same amount of coverage.
Wow.
That's the difference between affording $100,000 of coverage or $1 million.
There was one other analogy in the notes that made me laugh, but it's actually weirdly descriptive. It said term insurance is like a diaper.
Term insurance is like a diaper. At some point, you're going to have to change it.
It's vivid.
It is, but it speaks to the temporary nature of the need. You use it during a specific messy phase of life. And insurance is sort of the same.
And that segues perfectly into the why of it all, because I think a lot of people assume, well, if I buy insurance, I want it forever. But the Muneris strategy introduces this concept of decreasing responsibility.
This is the cornerstone of the whole argument. The theory is that your need for life insurance isn't a flat line. It's a bell curve.
Walk us through that curve, because intuitively I feel like I always want my family protected.
Of course. But picture a typical family at, say, age 30 or 35. What do their finances look like?
High debt.
High liabilities. You probably have a massive mortgage, maybe student loans, car payments, and if you have young kids, you have a huge unfunded liability in their future.
Right. Raising a kid to 18 is not cheap. If you disappear, that funding disappears too.
Exactly. So at 35, your risk is at its absolute peak. High debt, low savings. You need maximum protection. But now, fast forward 25 years. You're 60.
Okay. So ideally, the kids are gone, the mortgage is paid off, and I've spent that 25 years saving in my RRSP or TFSA.
Precisely. Your liabilities have dropped to near zero, and your assets are high. You are, in industry terms, self-insured.
So you don't need that $1 million policy anymore.
Your savings are the policy. So term insurance is just the bridge. It spans the gap between broke with kids and wealthy retiree.
It buys you time to build your own wealth.
That is it, exactly. And because you match the term to the liability,
Mm-hmm.
you're not overpaying for coverage you won't need later.
I guess the trick is just syncing up those timelines. If I have a newborn, I shouldn't buy a 10-year term.
No, that would be a huge strategic error.
Mm.
You match the term to the obligation. Youngest child is 2. You need a 20-year term to get them through university.
Just signed a 25-year mortgage.
Grab a 25-year term. It's that simple.
Okay, so we've established we're renting, not buying, to cover this specific high-risk window. But this is where people get stuck. The number. I've heard 10 times your income thrown around.
It's a decent starting point.
Huh.
Better than nothing, for sure. But Mansour's notes push for something much more precise. If you want to sleep well, you don't guess. You use the DIME method.
DIME. I went through this part of the notes, and it actually made me pull out a calculator. It's surprisingly thorough.
It covers the 4 pillars of financial loss. So D is for debt.
And this is everything that isn't the mortgage, right?
Correct. Credit cards, lines of credit, car loans, and you also want to throw final expenses in here. A funeral, legal fees, that can easily be $15,000, $20,000.
Grim, but practical. Okay, then we have I for income. This feels like the biggest variable.
It is. It's the most expensive part. You're replacing your paycheck. If you make $100,000 a year and your kids need support for another 15 years, that's $1.5 million right there.
Wow, that number gets big really fast.
It does. Now, you might not need the full amount because the payout can be invested, but for safety, you want a multiple of your salary times the years until your youngest is independent.
Is mortgage. That one's pretty straightforward.
Lump sum to pay off the house, period. You want the family to have a paid-for roof over their heads. No more payments.
And E for education.
Future tuition.
Yeah.
We're in Canada, so it's not U.S. level crazy, but for 2 kids, you still need to factor in, what, $50,000 to $80,000, something like that.
So you add those all up. Debt plus income plus mortgage plus education. That's your number.
That is your comprehensive needs analysis. But I have to flag one thing here that was highlighted in the Muneris data, because it is the most common mistake families make.
What's that?
Do not ignore the stay-at-home parent.
Yes, I saw this. The assumption is usually no income, no insurance needed.
Which is financially catastrophic. If a stay-at-home parent passes away, the surviving partner doesn't just lose a spouse. They lose the entire logistical engine of the household.
Who does school pickup? Who manages meals? All of it.
You have to outsource all of that
Right.
immediately. And you're paying market rates. The estimated replacement cost for that labor is often valued between $250,000 and $400,000 in coverage.
That's a sobering point. It's valuing the unseen labor.
You have to. Insurance is about replacing economic value, and that labor has immense economic value.
Okay, I want to pivot to the advanced strategies part of this. For people who want to really optimize, this concept of laddering stood out to me as something that feels like a hack in a good way.
It's highly efficient. It's all about not paying for coverage you don't need anymore.
So instead of buying one giant, say, $1 million policy for 30 years, you break it up.
Exactly. Think about that decreasing responsibility curve again. You need $1 million today, but in 10 years, maybe you only need $700,000.
And in 20 years, maybe only $300,000 because the kids are gone.
Right. So you buy 3 separate policies at the same time. You stack them. So for example, policy A, $300,000 for 10 years.
Okay.
Policy B, $400,000 for 20 years. And policy C, $300,000 for 30 years.
So on day one, I have all 3 active. That's my $1 million in coverage.
Correct. But 10 years from now, policy A just expires. You stop paying for it. Your coverage drops to $700,000, which matches your reduced need, but your monthly bill drops too.
And then at year 20, the second one falls off and the bill drops again.
And by the time you get to the last 10 years, you're only paying for that final small policy. It is incredibly smart. It customizes the insurance curve to your life.
What about writers? The notes listed a few, and they sound like menu add-ons. Are they actually worth it?
Most are just fluff, but Muneris highlights a couple that are critical. The big one is the waiver of premium,
This is for disability.
basically. If you get sick or injured and can't work, the insurance company pays your life insurance premiums for you. It stops you from losing your coverage right when you need it most.
That seems like a total no-brainer.
It is. The other one is the conversion privilege. This is your hedge against bad luck. It lets you trade in your term policy for a permanent whole life policy later on with no medical exam.
Wait, but I thought we didn't like whole life.
We don't like it for the average person building wealth, but let's say you're 48 and you get a bad diagnosis, something that makes you uninsurable.
Oh, I see.
Your term policy is going to expire eventually. With this rider, you can force the company to sell you a permanent policy that pays out no matter what. It locks in your insurability, even if your health tanks.
Okay, that makes sense. It's an option you hope you never use. Now, we have to address the investment side of this. The mantra you always hear, and it's in the Moneris philosophy, is buy term and invest the difference.
The golden rule of independent financial advice.
But play devil's advocate. Why do so many agents push whole life if term is mathematically better for most people?
Well, commission is a factor, obviously. But to be fair, there's a behavioral argument. Whole life is forced savings, you have to pay that premium.
Whereas with buy term and invest the difference, you have to actually,
So you have to actually invest the difference.
Right.
You need the discipline to take that $200 a month you saved and put it in your TFSA. If you just spend it, the strategy fails.
But assuming you have that discipline, the math favors keeping them separate.
Almost always. The fees inside an insurance policy are high and opaque. The fees in a low-cost ETF are tiny and transparent. You want your protection to be protection and your investments to be investments.
Don't mix them.
Don't mix them. It just dilutes the performance of both.
So we're coming up on time, but what about the actual process, the how? I think people still picture a nurse coming to their house to draw blood.
That used to be the only way. And for huge policies, it still is. But Mansour points out that many carriers now, like the ones Moneris works with, such as Amphi, offer no medical or accelerated underwriting.
So it's just a questionnaire.
It's a questionnaire plus big data. They check your prescription history, your driving record. If you're generally healthy, you can get approved in days, sometimes hours. No needles.
That removes a lot of the friction.
It does. But the number one thing is, do it while you are young.
Procrastination is the enemy.
Every birthday you have, the price goes up. Every little health issue, the price goes up. Locking in a 20-year term at age 32 is peanuts. Trying to get that same coverage at 45 is a different ballgame.
So if we boil this whole deep dive down to the essentials.
First, mindset shift. You're renting a financial shield for the years you're most vulnerable.
Second, do the math. Don't guess. Use dime debt, income, mortgage, education, and value the stay-at-home parent.
Third, be strategic. Match the term to the liability. Look at laddering to save money. And make sure you have that conversion rider.
And finally, you have to execute. This deep dive was heavily informed by the strategies and info from Moneris Financial Services. If you're listening and realizing you're underinsured, or you have a policy you don't understand, you can talk to them.
Mansour's the contact there. He specializes in exactly this kind of planning for Canadian families.
You can reach him directly. The number is 778-898-3202. That's 778-898-3202. Or email mansour@muneris.com.
And the site is muneris.com. That's muneris.com.
I want to leave everyone with a final thought that really came out of the reading. We started by saying people avoid this because it feels morbid, but there was a line in the source material that just flipped that on its head for me.
It's the question. If your insurance policy expired tomorrow, would your family's lifestyle expire with it?
It's not about betting on your death.
No. It's betting on their life. It's making sure that if the worst happens, the only thing they lose is you. They don't lose the house. They don't lose their future.
That is a powerful distinction. Peace of mind is knowing that plan is in place. Thanks for diving in with us today.
See you next time.